How's it going out there, Funk fans? It's Professor Phil again. I'm in your building. I was asked once again to do a video. I've seldomly done videos in some time, but because of the people I guess you could say, connected or plugged to, they have otherwise been, they've asked, not to be exempt from the silliness of the public. And so, I exhume my studies to give you a piece of the bond game. I'm going to start off with finance under Illinois compiled statutes, which is 30 ILCS 305 Bond Authorization Act, and which is suited at the very first paragraph, not the sentence, the paragraph. It says Section 1A, as used in this act, public corporations. It means any public corporation, anybody that is in pursuant to the law. That means any public, any body, corporate, organized by or authorized or pursuant to the laws of this state to carry out a public governmental function, including without limitations of the foregoing, the state, any school district. In other words, the state as in like someone that represents the state. Any school district or anyone that opens a corporation assuming to act as the state. Park district, city, village, incorporated town, county, drainage, or any other type of district, commission, authority, university, public community college, or combination thereof, acting through the corporate authorized thereof. So essentially, you open this corporation. You basically grant yourself the power to act as a government body and pursuant to all the laws, which of course you would have to apply by resolving them in the adoption of your corporation, so that your corporation, upon adoption, can thus exercise the same contractual rights and benefits under the seal or the signature of the corporation therein. All right. Bonds, B, or other evidence of indebtedness, mean any instrument providing for the payment of money executed by or on behalf of the public corporation on which the public corporation has assumed to agree to pay, including without limitations the foregoing bonds, notes, contracts, leases, certificates, and tax anticipated warrants. Tax anticipated warrants is basically taxes that they have warrants against, that they anticipate on getting their money back in full at some later date. And we're actually going to go over to we're going to get into the banking fundamentals to this, and I want you to keep in mind evidence of indebtedness. Okay, this is very, very, very important because it's not a vague attempt to negotiate. It is the attempt to negotiate. All right. So you got this whole section here that basically yields the possibility of bonds that are authorized by this act. Now, here's another thing that's very important, is where they actually have to file these bonds. And this is very important as well, that corporations can raise money with bonds, but they have to have anticipated revenue. Anticipated revenue is basically someone that you anticipate is going to pay futures contracts, such as tax, as it says, tax anticipated warrants, certificates, leases, other forms of contracts, and notes. So if you gave somebody a note, you anticipate on collecting on that, you can place a bond against it, indemnifying that it would be paid back in the future. It's just another way of borrowing money on leased money that you are ultimately indebting another party to pay back in the future. So it's kind of like wiping away your own debt, saying that someone else is going to pay the note, in which the bond will accrue a percentage of that note to be paid to whomever financed and underwrote your contract. Or that note, once the note's anticipation is guaranteed by the person in which, or the bank or the solicitor in which is going to collect on that particular instrument. And it says, notwithstanding the provision. Oh, we got a friend of mine. He's writing me about something. Okay. Notwithstanding the provision of any other law to the contrary, the public corporation may agree or contract to pay interest on bonds or other evidence of indebtedness and tax anticipated warrants. So remember, when you go down to you go down to the county clerk's office, you say, it's a deeds office or let's say the tax division. Hey, do you anticipate to collect taxes on my property? They will say yes. You'll ask them, not by definition, but you'll ask them the anticipation of those warrants are issued under what statute. Very important, because this tells you how the bond is associated with soliciting your contract per diem on an annual basis of what you are supposed to pay on, let's say, property taxes, city taxes. If you own a store, you can ask about contract taxes on items that are imported, exported, things in which are goods, serviceable, perishable, as far as foods and things of this nature is concerned. You'll be able to understand the premises of the tax code being used to indemnify and allow the state or the city or the municipality to finance itself with bonds, anticipating under that act that you're going to pay those that evidence of indebtedness at some point in time. Okay. And it goes on, pursuant to the law of the interest rates or rates not exceeding the greater of 9 per annum or 125% of the rate for the most recent date shown in the 20 GO bonds indexed of average municipal bond yields as published in most recent editions of the Bond Buyer, published in New York, or the successor publication or index, or any publication or index is no longer published than any index of the governing body. Index of long-term municipal tax-exempt bond yields then is selected by a government body at the time the contract is made for the sale of bonds or other evidence of indebtedness or tax anticipated warrants. So now they can take individual warrants. They can go from bonds to independent contracts of evidence of indebtedness or tax anticipated warrants that will be payable back to them in some way, shape, form, or fashion. Now, as a corporation, when it comes to separating power, this is a very good example of how they want to ensure that they can lock you in. At the very bottom of this particular statute, it says government units in entering into swaps may not waive any sovereign immunities from time to time available under the laws of the state of Illinois as to jurisdiction. That means that you can't, sometimes when they're just like, you're indebted and they get, say still state of Illinois gets flooded, their marketplace looks very, very, it does not look good. And it's taking a hit. This isn't good. This is bad business for them as far as their marketplaces are concerned. So they want to ensure that if they were to give you immunity from their jurisdiction, then that type of capital would be leaving their the vicinity of the state. They don't want that to happen. So they basically say from time to time, you can't leave the state because we need to ensure that any swaps or contracts that you may enter cannot be waived. All right. It says procedures and redeems, but such swaps shall otherwise be fully enforceable as valid and binding contracts as to the extent provided herein and by other applicable laws. So that means that if someone extends a benefit, but its redeems, procedures, and processes are still within otherwise enforceable obligations, meaning that you may pay more on the existing market to stay not only in Illinois, but to be able to process the application of the governing swaps that you solicit from, you may just be illicitly, basically, I guess you could say in a marriage sense, there's just no way for you to get out of it. In so many words, it's like you just can't get out, and that's just the bottom line. Anyway, that's for the Finance and Bond Bond Authorization Act in the state of Illinois. The next codification we are going to go to is going to be in Missouri and how their bonds react. Give us a moment. We'll be right back. It's Professor Phil. I'm in your building, Politics and Money. All right, and we're back. It's Professor Phil. Getting on to the bonds, and I was able to abstractly figure out something else, which they had the oaths as well in this particular this particular contractual, I guess you could say, tribalization of the state, giving such powers to the governor to operate the Missouri state agencies for surplus property. And that means that everything that you can think of that has some type of tax code attached to it is considered a state agency surplus. And that is anything that could be taxable on property, anything that could be assessed, anything that could be billed for the principle of the operations of the state in any way, shape, form, or fashion. The bottom line is to ensure, excuse me, that they're required to have a bond and access to it in order to borrow, lend, and access capital against it. Now, very important is that, like the other states, they can't just borrow money against a contract. And we're actually going to get back over to some friends of ours over at, oh boy, I forget the name of them. I'm going to have to look for the name again. I keep forgetting these guys because they're the biggest bond company in Missouri. Oh boy, I have to look for them here. I don't know why I'm not seeing them. The city of St. Louis Municipal Financial Corporation. That is the corporation that is essentially the like the secondary arm to the city's incorporated body. Even though this is the corporation by name and association, you can see here, and it falls under the Non-for-Profit Corporation Act, but no less the city of the city of Missouri is in fact they are in fact the entity that subscribes to allow the this financial entity called the city the City St. Louis Municipal Finance Corporation. Kind of teetering back and forth here because I'm looking for the company that underwrote the bond. Spoke about it in another and I'm just slipping here, having one of those days. I gotta look up the company itself because I have apparently forgotten. But let's see, their name will come up. Otherwise, I'll just read it off verbatim and then I'll figure it out from there. Oh boy, well, I'm not finding him because I can see the municipal markets. New Emma. Okay, this is the exploitation of the marketplace itself. But the entity I will find here, and then we'll go through the premises of what it is, what it does, how it operates, and all that good stuff. Let's get to the simple side of this, and that is here. Let's see, the governor being required to file a bond and his oath, and because they're kind of in the same place, the good part is that in the exchange they have one particular sentence in here that's very, very vital. As a matter of fact, there's several of them, but these are the ones that stick out the most. Okay. And it says at the very top of it, commissioners and administration compensation, oath of office, duties, vacancies, governor to serve. Now, as you can see, this chapter 37, office of administration. All right. The governor and I'm going to start here and then I'll emphasize what I've outlined here, or I've struck over, so that you can make this you can kind of advise that particular section is the most important. The governor, by and with the advice and consent of the Senate, shall appoint the commissioner of administration, who shall head the office of administration, which is hereby created. In other words, it's like a head of state, so to speak. Or, well, acting as the head of state, but more or less with the department, Department of State or something of that nature. Like secretary or even an undersecretary, depending on whom has the political clout. The commissioner of administration shall receive a salary as provided by law, and shall also receive his or her actual and necessary expenses incurred in the discharge of his or her official duties. Before taking office, the commissioner and administration shall take the subscribed oath. As a matter of fact, that is where I need to start the outline at. Sorry for that. Subscribe oath or affirmation to support the Constitution of the United States and to this state, and to demean himself or herself faithfully in the office. The commissioner shall also deposit with the governor a bond with sureties to be approved by the governor in the amount determined by the governor, payable to the state of Missouri, the same one that you saw under the Clerk of the Courts Act, under the Illinois compiled statutes. Same thing, same contractual distinction. The basis of whomever makes the claim, say the state of Missouri makes a claim against you, the state of Missouri has a bond payable to itself to essentially raise capital off of. That's the point of using the bond itself, essentially, because the capacity of it is to indebt someone else because of the evidence of indebtedness in which the state has created in the conditional basis of you performing to pay that debt, not the state performing to pay that debt. In other words, it's in reverse. Conditioned on the faithful performance of his or her duty of the office. The premium of this bond shall be paid out of the appropriations for the office of the governor. So basically, the governor says, I'm going to make a line item that says this appropriation will pay for the premium. You don't have to pay for anything. The condition of your contract is based on the obligation and the applicational apparatus of the legal necessity of keeping you fulfilled, and to ensure that the commission of financial gain is created to, I guess you can say, create the intent of reasoning, a logistic purpose for how do you want to put it, of influencing someone to believe that, hey, you're not only beneficial to us, you're beneficial to the public as an idea supplier for all the obligations that you are given as a mechanism for control. And of course, at the same time, it allows you to believe that you have some, as you could say, you have the means of producing what the public cannot do. Thus, you're special in some way, shape, form, or fashion, and plus you're compensated to be special, and no one can compete with you. So this is a relatively easy market to handle, and all you have to do is sign and seal documents. Great for them, right? Fees for expenses of distributing surplus property use, commissioners give bond. Very important. Listen closely. The state agency for surplus property may charge fees in the amount necessary for reimbursement of freight, handling, warehousing, transferring, and accounting for surplus property handled by it. In other words, the state, using you as like collateral, so to speak, can be warehoused, transferred, or handled, or reimbursed by freight. That means if you're driven around, if you're housed, if you're accounted for as part of a surplus property. It's like saying you're a slave inside of an entity, and the entity can be reimbursed, charge fees and in the amounts necessary to basically, it's like daddy. It's like what do you want to call it? it's like a caretaker that's taking care of you. They're asking for money from the state to do all these things. Monies so collected, found by the agency to monies so collected shall be used for the operation and maintenance of the state agency for the surplus property and for no other purpose. Any money found by the agency to be in excess of the cost incurred may be refunded within the fiscal period to the parties from whom the monies were received. So that means if they overcharge the state for taking care of you for any particular reason, they can be reimbursed at the end of the year or the end of the fiscal period, or quarterly annuals, or even an annual basis, depending on how their contracts are set up. The commissioner of the office of the administrator shall receive and keep all monies collected under this section and shall disperse them under the directions of the state agency for the surplus property in accordance with law. He shall give bond in the amount affixed and approved by the office of administration for safekeeping and faithfully administrations of the funds. The premium on the bond shall be paid from the funds received under law. So again, when they're receiving you, and then they're the item lines by the appropriating officer, the governor, transfers the financial goods or services via the private vehicles that need the funding to keep you housed or be paid for supplying the needs and legal apparatuses that come along with their exchanges. Ultimately, even though this is not a bond to be solicited under the premises of surplus property, the bond itself is affixed to that is approved for safekeeping and faithfully administration of whatever funds that you and the taxpayers may deposit into his or her hands for administrating the services provided under law. Of course, the last sentence pretty much tells you that they'll pay some of the premium money on the bonds that will be allowing them to faithfully administer the funds to be paid out to, of course, reduce. Actually, they can introduce new bills on the premises of money spent at your expense, and thus be able to enhance their means of soliciting more credit. Deposit of funds received from sale of surplus property, administration and use of funds. Now, again, think of the judgment as a debt agreement, a debtor agreement, and then we'll go into this part here that'll make more sense, and an attribution to the cost of living, the cost of being in prison, the cost of having to pay for debts, the cost of reducing and increasing credit for the same purposes. The monies received by the state from the sale of surplus property shall be deposited in the state treasury to the credit of the Missouri State Surplus Property Clearing Fund hereby created. The account shall be administered by the commissioner of the administration. When appropriated, the funds in the surplus property clearing account shall be used for the purpose of paying the costs of conducting surplus property sales. That means if you have a piece of property in which the state ultimately has in it, let's just say the city has acquired, and you haven't paid, let's say, taxes, or there had been a surplus spike. Their intent is to clear that fund by turning in. Of course, they even wrote off the exemption here. The Missouri State Surplus Property Clearing Fund established subjected to exemption. They actually waived that because in case you decided you want to use the statute itself to pay what primarily was the fixed price on the commission of the sale, meaning the buyback of a lien or something of that nature, the city wants reimbursement. Of course, the entitlement is to roll it over onto a bond, which then they can solicit from the marketplace. And of course, you can up the market prices, forcing the price on certain properties to go up intentionally to move people that can summer the prices down on the premises of buying either relatively cheap or buying at extravagant prices. So either way, in some way, shape, form, or fashion, they can push whole neighborhoods out on the premises of tax furloughs, which can fluctuate based on estimating market prices, fixed incomes, and the most important part is the inventory of economical appeasement, meaning that you have some economical advancement to ensure that you're able to keep up with the depository as it seems affixed to the marketplace, and see how the fidelity of those bonds, such as the one that I just showed you just a moment ago. I'm actually going to pull it up one time here, and this is St. Louis Municipal Finance Corporation for city parks, leased improvements, and dedicated revenue bonds, which is the city of St. Louis. That's what I meant right there, city of St. Louis, which is the leasee. So there are two different entities who are subscribing to the same territorialistic bounce, meaning one is bouncing off the other, and the prices, interest, yields, principal amounts, and all that good stuff on the CUSIP numbers that they're exchanging on the marketplace shows how the bond will fulfill certain needs and obligations throughout, you could say, the maturity years in the application of extending those financial apparatuses to keep the marketplace, and of course keep the city appeased at granting more revenue than there is available in the surplus, especially when jobs are extremely low and other job related entities are creating huge amounts of surplus on the taxpayers' back. That's another story. And the last sentence: the Commissioner of Administration shall distribute all funds received in excess of the cost of the sale to the fund which purchases the item sold. So basically, it's saying that let's read it together. The Commissioner of Administration shall distribute all funds received in excess of the cost of the sale. So that means when they make a backdoor sale with a bond, which allows them to access capital. Okay, now this is very important to read, because when I say capital, I mean it in a sense of whom they're going to borrow it from. Now you see here they say, and this goes for practically every city's revenue bond. I will show you one from New York, and it says practically the same thing. Full faith and credit of the city has not been pledged. Very important to read it. See? Has not been pledged to the payment of the Series 2014 bonds. But as we go down, we'll notice the full faith and credit again is said to not be the pledged payment, which basically is local taxation. Okay, so they took that out, right? We saw that twice. Okay, once, security and source of payment. Okay, so it doesn't come from there. And then twice, which says, again, the general, which is to give you the idea of what they're agreeing upon and how those monies will come about, does not come from the city's pledge, but it does in fact come from your United States government. You see, cash management. And I'll just read from the top here. All cash, and this is right here where I'm starting. All cash not restricted by law to specific accounts is pooled into the general pooled cash and invested by the city treasury. The city treasury provides cash forecasting so that adequate cash is available while investments are maximized. Consistent with the state law, all investments held by the city treasury are in direct securities backed by the full faith and credit of the United States government or its agencies, and those that may approve by the state treasury, or in the time deposits collateralized by those securities. Now, the wonder dog of this whole transition, and I have a call. I'm actually going to tell the person to call me in an hour from prison, unfortunately. I'm doing a case here. Yes, okay. Drop him in just a moment. Okay. Yep. And then oops. Let's go back. Well, we actually read it off. Okay. All right. Hey, can you give me an hour and I'll call you back? I'm actually busy doing a video, believe it or not. 1 hour. Okay, that's fine. Call me right after lockdown. All right. All right. Sorry for that. It's a small rift. Good guy. Good guy caught in the system of bad things. We'll get him out of there, though. All right. And to continue, revenue bonds do not constitute a pledge of the full faith and credit of the city and are not considered in determining the legal debt margins resulting in the limitations described thereof, meaning we can still outsource our credit, but we are not necessarily borrowing against the full faith and credit. Okay, so here we go again. Direct obligations. Let's see. Direct obligations of the United States of America in securities fully and unconditionally guaranteed as to the timely payment of principal and interest by the United States of America, provided that the full faith and credit of the United States of America must be pledged in any direct obligation or guarantee. And that's, of course, their way of saying that we have the imposing factor to say the United States is the grantor of all debt. Essentially, we're just we're the backbone that makes that obligation essential. Okay, and I'm actually going to go over and let me just knock this out real quick. We'll do the same thing with the full faith and credit for New York. Here we are here. It says the bonds will be general obligations of the state of New York, and the full faith and credit of the state of New York will be pledged to the payment of the principal and the interest on the bonds. Now, here's the great part, or I guess you could say the differentiation between one entity, which is one state, over another. The city said that. See, the city said this, that they're obliging this particular money. Now, this, on the other hand, is the state of New York. See, the difference is that the state can borrow its own money. The cities cannot. The city has to barter. This is the reason why they have to put bonds up in the first place. See right here? The bonds will constitute general obligations of the state, in which is its full faith and credit will be pledged. Now, the funny part is that if the state of Missouri wouldn't pledge its own full faith and credit, it means it doesn't want to pledge any debt that it does not constitute to pay back to the marketplace. They kind of backed off and just said, United States, you can back the assets, but we don't really want anything to do with it. Okay, let's look at this right here. We'll go through this particular section here. The transcript of proceedings in the forms of bonds enclosed with the comptroller's request have been examined by the members of my staff. You are advised that after consideration of the provision of the state constitution, the section of the state finance law and the statutes above referred to, it is, in my opinion, based upon such inquiry as members of the staff have deemed appropriate, that the bonds are legally issued in accordance with such constitution and the laws, and that the bonds constitute valid and legal binding general obligations of the state of New York, to which its full faith and credit are pledged. Now, let's go back into the full faith and let's go back into the I think that was the last one. Yeah, full faith. Let's go to the full faith. No, I'm sorry. Yes, the full faith and credit clause. Very important, because when you read this, you get the understanding of where this money is just constantly just reappearing, because numbers just allow this numeration of things to just happen. Okay, and the first sentence pretty much tells you what's going on. We've read it before. We'll read it again. Article 4, Section 1 of the United States Constitution, known as the Full Faith and Credit Clause, addresses the duties that states within the United States have to respect the public acts. Now, remember very closely that when you are filing something, you're in fact filing a public act, records, and judicial proceedings of not every other state, but in that state and any other state that respects that full faith and credit. Now, the great part about this is that it constitutes one serious fixture to the whole composition of this contractual thing they call full faith and credit. The basis of it is that they can legislate finances under the premises that the Constitution allows them to borrow money. This is what these bonds are made for. These are what these bonds are constituted to be borrowed against and for on the premises of something relatively simple. And that is that they're going to borrow taxable income from others. And let's look at something even more startling here: original issue discount. This is very important because I'm actually going to read this. And this is the reason why people were going to jail for making OID contracts. And they were just basically making taxable income available by using the surplus of OIDs. They were not supposed to do that. And here again, lies in New York's bond, the OID process is and I'm going to read it. OID, original issue discount, is the excess of the sum of all amounts payable to the at the stated maturity of a tax exempt bond, excluding certain qualified state interest that is unconditionally payable at least annually at prescribed rates over the issue price of that maturity. In general, the issue price of the maturity means that the first price at which this substantial amount of the tax-exempt bonds of that maturity was sold, excluding sales of bonds housed to bond houses, brokers, or similar persons acting in the capacity as an underwriter, placement agent, or wholesalers. This is what you were doing. When you put your OID in, you became an underwriter. Once they agreed to it, you became a broker. The time they sent you a check in the mail, as soon as they sent you a check in the mail, you became literally an investor. This is where investments, where your contract and the obligation of you reducing the entire amount of the bond except for qualified stated interest. If you do not qualify as stated interest, they lock you up. That is correct. They lock you up because you are issuing more surplus than there is available against anything exempt written off against those particular obligations. So say, for instance, you got tax credit. All right. You can turn around and write up a bond and put an OID against your exemption. You know, let's say child income credit, say business expenses, say gas expenses to drive around, things of this nature. All that comes at the exemption yield. But if you turned around and issued a bond with an original issue discount, which obliges the IRS to not only introduce the exemption of those receipts, they then refund you on those receipts. That's right. They refund you on the original issue of exempt obligations in which the bond would present your claim. But yeah, a lot of you went to jail and basically defaulted on loans in which, as an investor, you had no idea, you didn't know what you were doing. Okay, let's just keep it real. That's what it is. Okay, so let's go back into it and read the rest of it real quick. In general, the issue price for for each maturity of tax bonds is expected to be initial public offering prices, meaning IPOs, set forth on the inside cover page of this official statement. The Attorney General is further of the opinion that for any tax-exempt bonds having OID, discount bonds, original issue discounts, discount bonds that have accrued is properly allocatable to the owners of the discount bonds under section 1288 of the code is excludable from gross income for federal income tax purposes to the same extent as other interests of tax exempt bonds. So what this means is essentially is that if you have a source of income that says it's allocatable on income or on contracts that falls under section 1288. Let's go look it up real quick. Section 288. Let's go look that up real quick. Get a good look at it. I'm not sure if it's in here, but it may not be. Probably not. And that's probably an IRS code. So more than likely, we're going to want to go IRS section 1288. Let's look that up. and see how this is. Yeah, treatment of original issue discounts. So long term, blah, blah, blah. Treatment of original issue discounts, a tax exempt obligation. The adjustment applicable to short form, midterm, and long term rates are set forth of the month. And so they're setting rates on what you'll be able to underwrite without winding up in a specific tax bracket for soliciting your original issue discount. As long as you fall under this particular section, the treatment of it will be exempt like any other tax exempt bonds. That means that the same thing the city offers, the creditors offer, businesses offer, things of this nature. As long as you fall under that particular section, it will be treated like a tax exempt bond. And to be honest with you, what they really mean is if you have excess in taxable income, as long as it doesn't exceed it. That's what I'm believing they're at, because when they're talking about businesses, they're talking about statements that exceed or wouldn't exceed the amount that they're actually making in capital, whereas their threshold derived from their long-term adjustments would be credit spent, and that means money that they spent on their business as either an expense or a write-off, or a guarantee that the federal government will pay them the original discount back in full if they reduce how much capital they actually made. So if I made 50,000, but the access in the liquidity of my receipts and deductibles are say it's under 50. Let's say it's about $30,000, and they say that threshold is at say 4.3. I have to reduce myself to a 4.3 income bracket that allows me that $10,000 release on my OID, which would allow me to then raise that as quote unquote capital. It's just another way of saying I'd rather spend money to make money. You make more money by spending it over a period of time, in which gives you Section 8's 122 treatment of your original discount to be a tax exempt obligation. And to do that is like, it's next to saying in so many words, I want the federal government not only to recognize me, I want them to give me surplus, so then they can see that I'm harvesting a relationship to introduce the treatment of the type of bond that I'm issuing. Okay, especially the fact that if I'm trying to localize my money, I'm definitely trying to maximize my credibility, and at the same time, I want to make friends at specific functions, or you got to think like a corporation. You have no idea what they're thinking, but they're definitely trying to make moves, and they're trying their best to make money at the end of the day. Okay, so we got those two particular bonds out, but and we're gonna go to a section which is relatively tight when it comes to the bonds in public works and public and private entities. Public entity, for instance, can be any number of these things, which are official in any official board, commission, or agency of this state, or any county, city, town, township, school, road district, other political subdivision of the state. Now, here's the thing. Really, where this falls in right here, agency of this state means that any number of, if you create a corporation and you say, you officially claim an office in which would be entitled to this particular section, you can call yourself any number of things. And of course, contractor is a very good way of saying, in a general sense, you can be any number of any one. If I go down to the city right now and negotiate a contract and they call me a contractor, I'm considered an agency of the state. The reason why is because I'm plagiarizing that the state can allow me to introduce intravenously into its business stream, being locally recognized, almost like a quasi-government agency, doing the works in which the city effectively wants to spend money to create jobs to do. So, ultimately, if you're a minority contractor, for instance, this fits right on into where you happen to be at. Now, here's another great thing about that is at the very bottom, and this unfortunately goes for the courts and things of this nature. Okay, a public entity may defend, and this is the very bottom, number 5. A public entity may defend, save, harmless, and indemnify any of its officers and employees, whether elective or appointive, against any claim or demand, whether groundless or otherwise, arising out of an alleged act or omission occurring in the performance of a duty under this section. The provision of this section do not in case in not. I'm sorry. The provision of this section do not apply in case of malfeasance in office or willful or wanton. Well, I can't even pronounce that. I don't know why I can't see if it's well, it's my computer. Neglect or duty. So let me move this. Waiting, yeah. Neglect or of duty. I actually have to look that word up. You learn something every day, right? Okay, and then we have the Office of Administration, the general services that they have, and if one was to get into a contract in such a way, say criminal, civil, traffic, whatever, you can actually transfer your funds that are accounts receivable for their cash revenue. And what that is right about here. Transferring appropriations. I have an Apple, unfortunately. This is an exe file, so I can't open any of these. These are not. I'm gonna have to get on probably a Windows computer to open on any of these files. That sort of sucks for me, but hey, you're lucky. I'm not. You got manual warrants. Multiple vendor payments, how they pay vendors and whatnot. Everyone from the courts to city workers, to minority contractors, to conglomerate corporations that ultimately create these flabbergasting financial I guess you could say means to produce huge amounts of capital while looking like a minority program, while looking like smaller corporations in comparisons to huge conglomerates that come down and do millions huge conglomerates that come in to do huge amounts of business with the state, who fundamentally break those monopolies up and make them look relatively small in comparisons to a common minority programs that wind up getting wiped out, mostly based on small companies bidding on relatively exclusionary products, especially contracts for service temp work. I mean, they are all over that. I mean, there's no question about that. If you happen to have a minority program, you are, I don't care where you're at, you're going to have a very hard time getting the city to give you a contract unless you have some type of influence or have an influence from those above, especially high above when it comes down to those corporate breakdowns that have solidified all these entities to do its bidding and otherwise hide itself from being the big nose sniffing up all the estate of contractual surplus. It makes it very unfair to even negotiate under the precipice that they're that any one of those unique companies are independent. I guess you could say minority in the same sense. A crippled or someone that is not someone that does not have the influence and impact, so to speak. And these people are probably relatively well related to the people that are negotiating in the first place. So, you know how that goes. I'm sorry for getting on a tangent there. And the original issue discount, OID. The discount from par value at the time that a bond or other debt instrument is issued. It is the difference between the stated redemption price, and maturity, and the issuing price. That means that again, the stated issuing price is going to be the entire entitlement, which is your W-2. Okay, The maturity price is how much you had actually made in deductibles, and which introduces intravenously the receipts that were on that made those the deposits of your deductibles possible. So essentially, you're like bidding against the fact that you had all these expenses, and based on the reduction of those expenses on your credit, you meet a particular threshold. If you're making less than 50,000, I guarantee that an OID will work just fine for you. If you're trying to go outside of that, where you're trying to do huge amounts, you're gonna have to see an accountant, or you can call Politics and Money, and we'll lay some cement for you. Of course, the next sentence and the next paragraph here, I'll read off. An original issue discount bond is a bond issued at the price below par, which is, just read on. The most extreme example of an OID is a zero coupon bond. OID is considered to be a form of interest, so tax issues can get a bit complicated. All right, so zero interest on a bond at par would be basically we don't collect on the actual interest of, even though it says it's form of interest, it is, but it is the entire principal amount. Your reduction or deductible would be the impact of taxes collected to pay those particular bonds off. That means the OID kind of like creates an extended long arm to say I'm not participating in tax revenue, gainful services, so to speak. But in reality, when they collect your tax property and they pay on those municipal bonds, they're in fact paying the interest on that zero coupon interest guarantee, which can be issued by any number of companies. That's why you get you get a utility utility bill, and you see at the very bottom, it's not going to say original issue discount. But what it will do is it will say something of the nature of a coupon offset, or something in the nature that involves their investments and the entitlements of those investments that show practically zero interest on your payments, meaning you don't get any return from those interest payments because they've zeroed out the coupon on the bond and asked for the introduction of that form of interest to be collected on any of the other tax issues that have been mandated by their bonds, in which solicit the city to raise funds for on their behalf. Of course, quietly, because they're saying we're creating jobs, when in fact they're paying companies to create with your tax money, to create more liabilities, extending their investment into those particular interest-bearing entities or interest-bearing ideas, like taxes on property, taxes for driving, taxes to create other entities that subscribe and are then created by the state to otherwise manifest new revenue sources. So you already know what time it is. It's Professor Phil. We just got done doing Missouri. Oh, and you know what? I just thought about it. Speaking of their invoice possibilities, here you see the report of the state-owned surplus property. If you can get your hands on this right here, this little doodad will show you the deposit codes and the financial instrumentalism that comes from your city property taxation. That means when they say that they quote unquote own surplus property, what they mean is they own the surplus on the revenue that comes from those particular deposits that come from the inventory of the state, the city-owned entries that show the entity's state surplus as being available. And when they can report that report goes into, of course, the inventory number, the complete description, which is required to show, city property or state property, state/city property, codification and a bunch of language, and then qualified for a particular purpose, and the condition code, which specifies the deposit codes in which the fund is required to be deposited, or they optimize it in in such a way that the conditional code will show where it's routed from in order for those deposit codes to be recognized in their system. Now, myself, as far as what the basis of acquisitioning the funding is that for every single city, municipality, quasi-government, quasi-political subdivisional entity that subscribes you into these laws, these resolutions, contracts, and things of this nature, the basis of all of this is just simply for revenue. So as I stated before, you already know it's Professor Phil, Politics and Money. I'm actually going to come back and do one more for you. Drop you a line on the California statutes and show you a little something on the other side of the wild side when it comes to bonds. And of course, with all this good information, I'm sure you're feeling just a bit delirious and just looking over this information and saying, why? Why? But again, I want you to keep in mind the evidence of indebtedness and how such obligations will be issued. Oh, matter of fact, speaking of which, here's a very important notation here that I forgot, I overlooked. Obligations issued under this section shall not be guaranteed by the United States and shall not constitute a debt or obligation of the United States or any agency or instrumentalistic thereof other than the bank. Now, great part about this is big evidence that tells the United States that the United States has no contract with the states to borrow their money, or let's just say solicit money, except for that the bank is independently selling capital. It is not selling Federal Reserve notes. It's very important to understand the difference. When they're selling capital, that means that they're saying that they have surplus available. So if I go and look on their books and it says there's 300,000 some odd dollars, they just sold a house the same day that I went in to go get money, then they're basically selling me securities. They're not selling me Federal Reserve notes. Very, very important to look at this. And I'm telling you, you don't have to argue with any banker. This right here is proof that in no way, shape, form, or fashion is the United States securitizing or guaranteeing any money. Even FDIC cannot guarantee it because it's not a federal agency. Very, very important to check out. So, you get around to it, size them up and, go in there and tell them, hey, I got evidence of indebtedness, dude, So are these constituted as notes or bonds or anything of that nature, especially if I put it into a transcribed contract? If they agree, you go and make yourself a bond. And your evidence of indebtedness is how much you want to borrow against the evidence of indebtedness in which you anticipate on bonding. So if you're going to bond a $10 note for a $100,000 contract, if it's transferable on a tax note, meaning you file it at the city, county, or municipal building in which the county deeds or recorder is at, and you say, I'm going to record this as evidence of indebtedness. I just need to get my signature party on, but I need to get this filed first in order for it to become a official public record. An unsigned note is just as good as a signed note. So if you put in that bidding contract on the premises that the bank will access an amount of capital in which would exceed the amount of the note, but would be taxably transferable, then the payable account that you're creating is based on guaranteed funds that they securitize and, of course, sold you a security on the principle that they had access to actual capital. That means non-constituted debt. Capital, money in your hand, in other words, not obligation to the United States government, because it constitutes itself in indebting banks to solicit and borrow money. If it's not borrowing money, meaning it's already lent out the surplus it had available on its tally sheet at the end of the day, then they've given you a security. So just something to keep in mind. Again, Politics and Money, Professor Phil. I'm out. I'll be back in just a moment. We're going to get on to California bonds. And then, hey, you do your research. All right, for this last section, we'll be talking about California bonds, and I'll try to make it somewhat short to a certain extent. And we're going to go over to the great state of Florida as well. I'm actually going to have to pull up one last thing. I'm just forgetting the name of it. boy. Resolution. That's right. So we want resolution because this is very important for us to understand how one could use a resolution on the same premises of the way the government uses it. In other words, to resolve issues, to create forms of legislation, and to otherwise contract contrary to belief with the very entities in which we are subscribed to under the form, the abominable entity, as we see as the this ridiculous size snowman. It just simply won't melt. Okay, it won't go away. It's just this huge abominable snowman we like to respect as a government. All right, so here we are, Government Code Section 975-978.8. All right, and I'm going to go right in here and just snub it from where it begins and ends at. Whenever the board deems it necessary for a local taxing entity to accrue a bond indebtedness to fund all or a portion of the outstanding judgment against an entity, it shall by resolution state the necessity for the indebtedness, the purpose in which the proposed debt is to incur, the amount of the proposed debt, the time and place for the hearing of the board of the question whether the local taxing entity should incur a debt indebtedness to fund all or portion of the outstanding judgment against the entity. Now, here's the crazy part about this. This is very important. Is that when they put a question on the ballot, or let's just say they're putting in a question resolution. Let's just look it up real quick. Let's see if I can actually find something that would, or let's say a ballot question. Let's make it easier because this is very much politics than anything else. All right, so spelled that wrong. Sorry. All right, so a ballot question, statewide ballot question. Let's see the definition of this. Okay. Here we are. Statewide ballot question will appear on November 4, 2014 state election ballot. So here they are, basically asking the public, yay or nay, should we or should we not? Now, here's the funny thing: these aren't taxpayers that they're going after to authorize this transaction. This is in fact voted by an entity called the state legislative branch, in which it entitles itself a tax identification number like anyone else. They call themselves taxpayers, so they're working for someone. So apparently they have to be working for some type of company, whether or not it's simply a branch of government or a non-for-profit. It's all the same, okay, at the end of the day. But here they are, it's basically saying in so many words, should we or should we not? It says a yes vote would eliminate the requirement that the state's gas tax be adjusted annually based on the consumer price index, or no, which would make no changes in the law regarding the gas tax. So in other words, to pass a proposal, one has to put something before you. All right, and this is where the entitlement game had kicked off relatively hard on the premises of the sort of entitlements we garden to guard and respect in regards to the way the government operates, such as Social Security, Medicaid, things of this nature. The basis of that is subsidies that the government can turn around and offer to private companies and investors for one particular purpose, to say that the people will pay for it, and the entitlements to those issues on the basis of raising capital will fall on those that actually have capitalistic means bestowed onto them. In most cases, the middle class don't really get touched unless, of course, there is simply no other way to raise the revenue gap, and they just have to make a few adjustments where not huge sacrifices, but a spreadsheet of sacrifices where some will fall to the wayside and others will survive. So in the indication that a resolution is passed under the circumstances of basically creating more rations than there is available, one has to say, okay, if we do this, then what are our capital outtakes as far as bridging more jobs so that capital can be readily available to pay back this debt. Capital, I mean, as in money being leased and loaned from the bank, guaranteeing means of creation of jobs, or otherwise being capitalistic in such a way that people come to us to ask for taxpayer dollars to create jobs. Otherwise, in such a way that it does create a tax-based relational type of adjustment. If you tax here, you got to create jobs there. At least that's the equivalent of balance. But when you got an institution known for giving out entitlements simply because they want to be the ruling class of those finances, then you put some relatively dumbfounded individuals in the office, and just because they look good, smell good, and look great in a suit, it makes it more or less the concocted arena more legitimate. The smell, the taste, the touch of this politicianal grace, and all of a sudden it just seems like it all works itself out, right? So, and before we get the resolution, let's look up the definition here, okay? Definition we have read numerous times. I want to read it so that you know what it really means, or at least the listener, or whomever happens to be watching this video. In law, resolution is a motion, a written motion. Now think of it as a motion in a court, okay? Adopted by a deliberate body. That means that it has to be passed, meaning it has to be agreed upon by, say an attorney or some of that nature. So here you are with someone. Here you are with someone that you're basically telling them, in so many words, I want you to adopt this because I want you to agree. In order for you to agree with what I'm doing, I need you to assess the value of this motion, meaning that I want to not only resolve it, I want a agreement which assesses me and then allows you to create the value from it therein. All right, or thereof. The substance, and I continue, the substance of the resolution can be anything that can be normally be proposed as a motion. For long or important motions, though, it is often better to have them written out so that discussions is easier, or so that it can be distributed outside the body after its adoption. An alternate term of resolution is resolve. Resolutions are commonly used in corporations and houses of representatives. Let me outline that for you. Corporations and houses of representation, okay, or House of Representatives, all right, House of Legislation that is, but House of Representatives in the same sense. All right, so here we are, and we're going to read how a resolution is the idea for bearing taxable, basically using the public's tax furloughing system as they have full advantage on the premises of having an entity in place, of having contracts in place which construe laws to their benefit, and most importantly, the fact that we're not contracting with each other allows them to furlough these taxes even further on the premises of creating new laws, and of course facing the penalties of resolutions passed to raise revenue from those particular bills and resolutions. It says the copy of resolution published or posted shall be accompanied by a notice subscribed by the clerk or secretary of the local taxing entity that the hearing referred to in the resolution will be had at the time and place specified in the resolution. At the time and place, any person interested, including persons owning property within a local taxing entity, will be heard upon the questions stated in the resolution. So that means you're not going to believe it. Yes, they said it in so many words. You could, in fact, go in and not only question it, you can tell them, look, if you're going to raise money for a particular bond of indebtedness, I do not want my property as an investment to the city or state's furloughing of higher tax ratio to, you could say income, you can say reduced OID processes so that corporations can get subsidized to harvest more financial rift that causes the city to put more revenue bills on the books that induces me to wind up having to stop, be frisks, to otherwise pay any type of commercial fees to keep the city operational and functioning, because we have to make up for the tally debt that we just got done incurring. So it's kind of like a, in so many words, you can come in and not only you're entitled to question it, you're entitled to withdraw from it as well. It doesn't say it, and remember, they never say what you can actually do. If they said that in the law, well, most people would be able to follow the law and do exactly as the law says. Because it doesn't say it, you have to transcribe it in such a way, not only in your mind, but in the physical sense of going out and doing something and saying, I can do this. So this is beyond you. This is about control. This is about manifesting something you can control. All right. So like I said, I was gonna make this short, and I'm not gonna go into any of that. And now we're gonna go over to Florida. Yes, I do like that place called Florida. I happen to like Florida. So, okay, state bonds, all right, means, and this is very important because it's just like any other. Now remember, this isn't a city, this is a state. State bonds mean bonds pledging the full faith and credit of the state of Florida. Okay, very important. And OID, the original issue discount, means the amount by which the par value of the bond exceeds its public offering price at the time and it's originally offered to an investor. Now you would wonder, how does, even though they say that now remember, they're saying by par, meaning that the amount that would be exempt exceeds the amount that would be received, but in reality they really mean the actual value, and by par, the reduction price of the original offer. So it's convoluted. I can't, like I said, the OID process pretty much primps it out in such a way that it's in its language. The OID essentially invests in inflation. That's basically what it is. Money where there is no money, and then exceeding the price would ensure that whatever tax value that would come from it would be either exempt or would be placed on others that would pay the wholesale deposit on how much the OID, the original issue discount, was valued at. Okay, so your W-2, for instance, if you return your W-2, you're going to get credit back. But the problem is when they return the entire the entire amount back, the taxation for that amount is what they want as a return. So you should be returning your money. You should be returning the amount they would return to you. So if you get $2,000 or $3,000, and that's how much this tax for, that's the by par amount that you should be paying back to the quote unquote investor. That is the IRS. When in reality, they're making you look like the investor. And since you didn't pay taxes on the contract, and contrary to your belief, is now a liability because you've increased. Not only did you benefit from the entire amount, but you have used the surplus system illegally without a warrant or a contract to settle the debt. Okay, that's just the definition. Right? State bonds and revenues. Let's go here. The issuance of state bonds pledging the full faith and credit of the state pursuant to 11 Article 12. Article 7 of the state constitution is hereby authorized upon approval by the vote of the electors, except otherwise authorized in said section 11, Article 7. The amount of such state bonds, other than refunding bonds, the projects to be financed thereby, and date of such vote of electors shall be provided by law. In other words, if you're using a law, and unfortunately they're saying electors, but it doesn't necessarily mean that they're doing it on your behalf as a revenue component. If you do it as a revenue component, then you can raise funds for your elected officials. All you need is a co-signer, and that means that now you can raise revenue the same way they do, but you'll need just like a constituent-based agreeing party that wants to vote them in, you have to have, you need barter in exchange for such votes, meaning you need people that said, I want to enjoy the same benefit, therefore I'll pay my taxes into your entity to subscribe a tax revenue bill. All right, so yes, it can be done. Everybody can do it. Absolutely. The issuance of revenue bonds payable solely from the funds derived directly from other sources. Other sources than state revenues. This means that ultimately, again, anything deriving, if you come to me and you say, Phil, I want you to take my taxes, I want you to put it in City and Roads, and I want my child to work for City and Roads, but make sure that no contract shows that there's a connection between you arbitrarily taking my taxes and placing it into that particular entity, and more importantly, that entity is subscribed to ensure that my child would enjoy the benefit of being a part of that road construction contract, then of course I'm pretty much the person that would say, okay, all right, we're gonna re-revenue it here, and here's how it's routed. The premises of these contracts, which is an agreement between I and the taxpayer, that I'm going to not employ him, but I will employ the general public, anybody that wants to bid on the contract, so that the revenues will be pursuant to that particular road contract or city city dwelling or whatever, anything of that nature that would be consistent of the city or the state putting forth bonds to contract for those benefits. If it's rerouted in such a way that taxpayers are willing to do it so that the city or the state doesn't receive the revenue, that means you're taking back and you're taking charge of your state constitution. You're hereby, and here it is in section 11D, article 6 of the state constitution. You are then hereby authorized without a vote of the electors in the manner provided by law. So that means if it is solely the base of your funds derived directly from another source, meaning coming out of your pocket for state revenue purposes, you have the state revenue contract, in which is pursuant to a particular law and pursuant to the Constitution, that's 11D Article 6, it is then hereby that you are authorized without a vote of the electors in the manner provided by law to provide bonds to equitably create jobs. Absolutely. You can do that as well. All bonds hereby authorized shall be issued in the manner provided by the Constitution or by the division in manner provided by this act, subjected to other applicable provisions of law. Wonderful place, I tell you, wonderful place. And not because it's just totally corrupt. There are some relatively large corrupt pockets down there, but hey, yeah, I just like it down. I like Florida. Florida's a nice place. I like that place. All right. Most of this is, just administrative stuff. Let's see, bonds, right-of-way acquisition of bridge contracts, finance for roads. Let's see, fees for expenditures, fees. Okay, let's see here. Bond fee, trust fund expenditures, schedule of fees. All right. Let's see how this is sinking fund. This is more of a, these are public expenses for creating a particular trust type of fund constructed to convey how bonds would be used. Or how anything could be used in the abstract sense to furlough entitlements into that sinking fund. It looks like just a little side reading. Let's see, bond securities for public bodies. All bonds issued by the division, either for the state or on behalf of any state agency pursuant to this act, shall be constituted legal investments for states, county, municipal, and all other public funds, and for banks, saving banks, insurance companies, executors, administrators, trustees, and all other fiduciaries, and shall also be and constitute securities eligible as collateral deposits for all state, county, municipal, and other public funds. Now, so that means, let's say you get a ticket. There's a young man down in Florida. He apparently runs into tickets like a boxer runs into a pair of gloves, to the face and to the body and all the other physical orifices that can wind up crippling the benefactor. At the end of the day, this right here, very important as far as indulging this read here, means that if I was to, he gave me his contract, his state ID, for instance, and his subcontract, which is the ticket. I turn around and I issue a bond, but the bond is securitized on two premises. I'm acting as a fiduciary, and I'm constituting that the eligible collateral for all the deposits is state revenue, and the state revenue comes from people that are local. So I go to local people and I say, hey, I got $100 note here that says he has to pay, 100, 200, $300. That's a large amount of money. I don't think he wants to pay that. So what tax do you pay that primarily puts you in a real bad bind? Oh, well, I don't like paying alcohol tax. Okay, alcohol tax. How much is alcohol tax? Let's say it's 10%. So 10% of the revenue value of that bond now allows me to execute a contract that says this entity, essentially, as a fiduciary acting on behalf of another party, can now come in and say, hey, you know what, Your Honor, check it out. I got a revenue bond that will raise X amount of dollars over a period of time that will ensure that this ticket will be paid. I need the benefactor of going before the city, and I will offer this pledge that will not only pay deriving the tax from another source of the of a public fund that's taxable, but the taxable eligibility is contracts that I have received in which the benefits will be transferred via the appropriations of that particular code, or the codes for the alcohol tax or tobacco tax, whatever it happens to be. It doesn't matter what it is. I use alcohol and tobacco consistently because, well, for the most part, the biggest tax for those that happen to be oppressed are usually those vices that are not exactly good for you. Bad habits, food, beverages, nicotine, things of this nature. So a lot of the taxing power right there erodes from allowing these endowment funds that are OID processed and virtually behind closed doors are handed huge amounts of equitable monies just on the premises of paying back loans that these bonds are lifted off in the first place. So essentially, why give it to the private sector, and why give it to the tobacco companies? Why give it to the alcohol distills and things of this nature, and giving your money directly to the city, who's just more than happy to hand those tax revenues over to these entities and keep it right there in the city? Keep it in your subdivision in which you're giving money to pay a supposed quote unquote debt, but yet still you're gonna pay for someone else's advancement. You're paying for distilling alcohol. You're paying for cigarettes you're gonna buy. You're paying for all these good things, but at the end of the day, what really happens? You know what really happens? I'm gonna tell you what really happens. What really happens is the private sector makes huge amounts of money, saves huge amounts in taxation, and you wind up overtaxed and overwhelmed and burdened with bills that you can't pay back. So you ask yourself, how does that all fundamentally work out for you? It works out on, well, one big note. One, if you're paying somebody else's debt, what you're doing is that person can promise to buy something for you, promise to do things for you. These are called in political circles, this is called influence. That means I can say, I'll give you a contract, you pay on it, and I'll promise you concessions. It's a fair exchange. Everybody wins, no one loses. The question is how long does it take for you to realize that winning means you have to negotiate with each other, and losing means you continue to just spread out and do as you see fit and believe that you can do it all on your own. Please, the ignorance has to go. It has to. That you have to do something with that. You have to put it in someone's purse, under a car. I don't care. Just do something with it, because this is your future. And if it is not, it is the sole base of your ignorance that puts you in your situation and will keep you under those circumstances. Okay? Trust funds, the proceeds of all bonds, all taxes, revenues, and other funds provided for this act, and proceedings which authorize the issuance of bonds shall be and constituted trust funds, and shall be used and applied solely in the manner for all the purposes provided in this act, and proceeds which authorize the issuance of such bonds. So let's just look at the full. Oh well, no, you know what? That's not it. Yeah, that goes right back to what we were looking at here. Yeah, that does. So, let me see here. Make sure I'm looking at that right. Yeah. Goes back to the same thing. So, okay, refunding. So whatever is payable under a fund, that fund will be replenished via that contract or via the trust fund that they created under that particular section, which is statutorily, or you can even call it a statutory trust. That's how it's created. Okay. And a lot of people I know, they're gonna, oh, it's just an ordinary. No, it's not. It's statute. If they passed it by statute, it's not constitutional. It's constitutional on the merits that it was created under the premises of the Constitution, but its sole purpose is gains, and gains are not something that the Constitution was permitted to do. The Constitution was to, well, serve and protect, but ultimately it's a commercial transaction and a commercial contract at the same time. But it has not been acquired to do things in which statutes have been providing all this time. Okay, the Constitution and statutes are completely separate, and in a sense, in all senses, are completely different animals. Okay, pledge of state. The state does hereby covenant and agree with the holders of bonds issued pursuant to this act that the state will not limit or restrict the rights hereby vested in the board or the division or any state agency on behalf of which such bonds are issued to construct, acquire, improve, maintain, and operate any capital projects financed with the proceeds of bonds issued pursuant to this act. Again, if you were to construct a contract in which you've acquired a contract from said person in another side of town, and you then give them concessions on the premises that they're going to buy or pay for something, and that contract is then paid with your tax money, those bonds, in pursuant to the actual act, is considered a capital project financed and operated for maintenance by any entity that entered into the contract, as the bond would pay out to suffice for public funds, or suffice for statutorial replenishment, meaning that instead of him paying and him paying you, this means that your taxpayer dollars are working in a different kind of way. It's not working no longer to pay for alcohol distillment or for the tobacco. Let's say it's a tobacco act. Well, they have plenty of tobacco acts, but let's say the tobacco act, you're paying under that. So that at the end of the day, it isn't about them paying out. It's the fact that they've used the statute to provide huge amounts of relief to itself and not to the people. Okay, to levy, fix, establish, and collect such taxes. This is something that your contract, contrary to your own belief, can do. You can levy, fix, establish, and collect taxes, but you're not doing it in the real sense. You're doing it in the abstract sense, meaning you're handing your taxes over to another, as I continue, revenues and other funds which are pledged for payment of principal and interest on said bonds or reserved therefore. So, If your money's reserved for the principal and interest of said bonds, that let's say a bond was issued on the premises of a speeding ticket, then the obligation is solely reserved for the principal and the payment and interest of that particular bond. Okay, so that would take out of, you can go to a local store and say, hey, I'm exempt from paying taxes on this. Courts oblige the city to allow me to buy tax-free. Now remember, the store owner now, once he becomes a co-signer, he can go back to the city and say, I want the revenue on the taxes that I pay for these stamps on my cigarettes. So now he gets redeemed because your tax money is now going elsewhere, as is the exemption on those tax bonds. Those exempt bonds gave the premises that you're no longer paying taxes on cigarettes. So it coincidentally, you can actually do this for the owner. So the owner saves money, he makes money, and at the same time, you can kind of put a little fixed price on it. You can up the price just a little bit, but you're helping him. And be honest with yourself. You don't want him to make too much, because he may get a little, he may take it all the wrong way. You might get into a contract with the wrong type of party. Any number of things can happen. You don't want that, okay? To fulfill the terms of any covenants and agreements made with the holders of bonds issued pursuant to this act, or in any way to impair the rights or redeems of the holders of such bonds until all bonds together with the interest thereof are paid and discharged. Now, when you pay that debt all the way off, it is then paid and discharged, meaning the amount that you would have been taxed on cigarettes would be paid and discharged for that particular ticket. So yeah, there's a vast amount of information here, and I'm not gonna go through all of it, but I hope you got a good idea about it. As far as the California and the Floridian connection, of course, you already know what it is. It's politics and money. Professor Phil, I'm in your building. You can contact me at Politics and Money, POLITICSANDMONEYINC.com. Or you can contact me at the same email, which is PROFPHIL at politicsandmoneyinc.com. And by phone or cell phone, which is you can text or call at 424-245-9408. Anyhow, thank you for listening and watching, and I hope you learned something today. I'm out. Peace.